You know, for decades, the titans of the trucking world all seemed to be driving in the same direction. But in 2025, that all came to a screeching halt. Based on our deep dive into their financials, the industry's biggest players have just placed massive, and I mean conflicting, bets on the future. So today, we're breaking down this high-stakes tech showdown.
And this is really the heart of the story. The industry's big three are just not on the same road anymore. You've got one going all in on hydrogen, another is basically betting the entire farm on batteries, and the third, well, they're playing it cool, letting the others spend big while it perfects the technology we already have.
Our analysis, digging through their 2025 annual reports, shows a fundamental split in strategy. Seriously, the decisions being made right now are going to be the ones that decide who dominates the highways for the next decade. It's a huge deal.
So where's the first major battleground? It's all about decarbonization. Now look, everyone agrees that battery electric trucks are part of the future. But when you bring up hydrogen, oh boy, that's where the industry is deeply, deeply divided.
And you can see these three distinct bets laid out right here. Daimler Truck is hedging. They're pursuing both batteries and hydrogen, figuring that different routes are going to need different technologies. TRATON, on the other hand, is making a really bold, single-minded bet on battery electric. They believe it just offers the best total cost of ownership, period. And then you've got PACCAR, taking a much more conservative route, improving the diesel tech they already have while keeping their long-term options open.
But the biggest split, the real point of contention, it's all about hydrogen. Daimler is the true believer here. They've got trucks on the road right now, racking up over 200,000 kilometers in customer tests. They're even building green hydrogen supply chains from the Middle East to Europe. But TRATON, they're the skeptic. They're convinced that the massive infrastructure needed just makes hydrogen a low-priority niche solution at best.
Okay, so even on batteries, where you'd think they'd agree, their approaches are totally different. TRATON is all about taking full control, pouring nearly $300 million into building its own batteries from the cell up. They're betting that this kind of vertical integration is the key to winning. Meanwhile, Daimler and PACCAR are sharing the risk, partnering up with Cummins to build a massive battery plant in the US. Two very different paths to the same goal. But the engine isn't the only battlefield anymore. The new competitive advantage, what investors call a moat, right? That durable edge that protects a company from rivals? It's shifting away from steel and hardware to software and data. This is where the profits of the next decade are really going to be made.
So you can really think of this as a three-lane race. In lane one, you've got Daimler, focused on standardization. They're partnering with their rival Volvo, of all companies, to cut costs on a common software platform. In lane two, there's TRATON, and they're all about commercialization. They're actually a bit ahead, with autonomous trucks already running on US highways. And in lane three, PACCAR is being super pragmatic, using its software to lock in that recurring, high-margin service revenue for years to come.
And here's the one thing that all three of these titans agree on, and our research confirms it. The real money, the real protection against economic downturns, is in services. The future isn't just about selling a truck. It's about selling a long-term subscription to keep that truck running, optimized, and efficient. All right, so big strategies are one thing, but the numbers, well, the numbers don't lie. When you follow the money, it reveals the hard evidence of these bets, and it also exposes where the real risks are hiding. 218 million euros. This number literally jumped off the page it asked from Daimler's report, and let me tell you, it tells a powerful story about the risks of this transition.
So what is it? That 218 million euros represents a non-cash write-down on Daimler's electric vehicle research in the US. It's a crystal clear signal that the company thinks the EV transition in America is happening a lot slower than they planned, a very real financial consequence of this high-stakes game.
Now this brings us to a crucial, kind of nerdy metric that analysts watch like a hawk, R&D capitalization. Simply put, it's when a company treats its research spending as a long-term asset, which boosts today's profits. But it's a huge gamble. If that tech fails down the line, it leads to massive write-downs. And as you can see, TRATON's rate is a notably high 44.5%, which signals either massive confidence or massive risk. And you can see TRATON's aggressive bet laid bare right here in the numbers. They're spending a massive 6.4% of their revenue on R&D. Daimler's also investing heavily at 5%. And then there's PACCAR, way down at a lean 1.6%. They're clearly prioritizing short-term profits and shareholder returns over huge speculative tech spending. Okay, so let's zoom out for a minute. Beyond this corporate rivalry,
What do all these strategies and financial signals actually tell us about the broader global economy?
Well, one key risk our analysts flagged is this. PACCAR's super lean approach means it's heavily reliant on a few key suppliers, like Cummins. In today's fragile supply chain environment, that's a major vulnerability that its more integrated rivals just don't have to worry about as much.
And here's a potential canary in the coal mine for the global economy. PACCAR's order backlog, which is a key indicator of future freight demand, has dropped dramatically. Because trucking is the lifeblood of the economy, a fall from $7.6 billion to just $2.6 billion could be signaling that a broader slowdown is coming.
So what are the key signals to watch? Well, our analysis shows the industry's advantage is shifting from just manufacturing scale to software and who controls the supply chain. At the same time, those falling backlogs are a warning sign for the economy. And on a company level, aggressive accounting like TRATON's R&D capitalization is hiding future risks, while PACCAR's deep supplier dependency creates a key vulnerability.
Ultimately, 2025 really set the stage for an incredible race. With billions of dollars on the line and three completely clashing visions for the future, the big question is this: which of these titans has placed the winning bet? The road ahead is wide open, and for the first time in decades, they're definitely not all driving in the same lane.